Well, good day, everyone, and welcome here. It's noon London time, not very far from the Greenwich Meridian, and I am delighted to welcome you to another FS Club seminar. Today's topic is a fascinating one, particularly at a time of the pandemic when we're seeing a lot of challenges to the insurance sector. And we have a special guest with us today, which is Dennis Mahoney, talking about insurance carriers and brokers, parasitic or symbiotic relationships. Now, I've known Dennis a while, and I know that he's got quite a bit to say. For those of you who don't know me, my name is Michael Mainelli. I am the executive chairman of Zien, and it is really, honestly, a privilege to be able to host these webinars. And the reason is that our various sponsors, which you can see before you here, are so kind in allowing us to range widely and freely across anything to do with technology, finance, or social purpose. And I think today we're going to be seeing all three, perhaps a bit more of an emphasis on social purpose and technology. If you'd like to talk with us about sponsoring, of course, the door is always open. And as all of you listeners out there might find, the website is replete with materials, information, and things forthcoming. So I shan't bore you with that. Today's format is, as ever, very straightforward. My job is to get out of your way as quickly as possible and let you hear directly from Dennis. Dennis is going to talk for approximately 20 to 25 minutes. He is very keen on your questions and answers, and he has a lot of material. And be aware, we will also have two polls in this webinar, so fingers on the buzzers, please. You'll see as well during the course of this that because we have time for questions, please look and use the GoToWebinar question facility. I'm not playing with my emails, so if you send me an email, I won't get it, but I will most certainly get a question you send directly. And we'll hope to structure the discussion, the second half of the discussion, so Dennis can get to as many questions as possible. The questions are recorded, or if you'd like to contact Dennis directly about something, we can pass that on for you, but after the webinar. So with no further ado, Dennis, if I might point out very much today that the floor is yours.
Thank you, Michael, and good day. I should start out by stressing that these are my personal views. They're not the views of any companies that I'm involved in or have been involved in the past. And as you said, I'd be glad to answer any questions or clarifications post this session if people request. I should just add that this was prepared originally in October of last year in Bermuda. And it was prepared in this format in the wake of the robust actions taken at Lloyd's. And it's for that reason that I chose the Plague of London in 1665 as a backdrop. I'm not a member of the Chinese government. I'm not a member of the World Health Organization. I chose that particular backdrop, if you like, to demonstrate what happens when we have major dislocations, unforeseen events. And so therefore, when looking back, it was either precedent or just simply coincidence. So that's the first point I wanted to make. Sudden, unexpected events which result in a dislocation between supply and demand. In this case, supply and demand in the insurance industry. So let's move on to the next slide, please, Michael, if you would. And I used another reference here, Lloyd's, for whom the lutein bell tolls. And some of you may be familiar with the actions which were taken by Lloyd's as a response to the performance of certain syndicates. And if we go to the next slide, you'll see exactly what I'm talking about, the top performers, the bottom performers, and so on. Now, clearly, the authorities at Lloyd's, John Neal, the CEO, Bruce Carnegie Brown as chairman, and Mr. Hancock, had no option but to take action in light of these results, truly appalling, a number of the syndicates. They are, at the end of the day, the stewards for a wonderful, nearly 400-year-old institution, and they are, of course, responsible for the Central Guarantee Fund. So they really had no choice but to take that action. And so I'm not here to do anything other than support them having taken that action. I want to deal with the consequences of that sudden and dramatic action. So can we move on? The question of the nature of that action was raised by Richard Brindle, who asked a very, very interesting question. Is Lloyd's a market or is it a single entity? and as a single entity, what is their ability to, if you like, police the actions of the individual syndicates. As I've just stated, they really didn't have an option given that they are the stewards, the ultimate stewards of the institution. The question, of course, that was being asked by Brindle is what is the likely effect of that action? And I'm going to cover that in a few moments in another slide. But in the meantime, we have seen Sompo, for example, the John Charman organization, withdraw from Lloyd's. So can we move to the next slide, please, Michael? Dirigiste is a word that I think I hear people talking about now in terms of Lloyd's, i.e. centrally controlled more than it has been historically. But again, I don't know that they had an option but to take the actions that they have and continue to take those actions. Thank you. One thing I will say before we address the next slide is that what's interesting to me as an observer is that when Lloyd's took these actions, quite a number of other insurers and carriers around the world immediately followed suit. They reduced their limits, they put up their premiums, they narrowed their coverage in very, very dramatic ways. It's almost as if someone was waiting for somebody to declare that now was the time for dramatic change, and therefore Lloyd's had the courage to be first, I guess, and put their heads above the parapet. But let's go back to fundamentals for a moment. If we can agree that insurers, and indeed reinsurers, only make money in two ways, either premiums exceed claims over any period of time, or they make up the difference from investment income. I would suggest, and I don't have the figures, that if we look back as far as 2005, it might be that the insurance industry globally actually would not have made any profit at all absent investment income and capital gains. I don't know, but I'm sure, Michael, you've got the ability to carry out that research and let us all know. Can we move on, please, to the next slide?
We'd love to do that, Dennis.
Okay, so here we have the 5,000-year history of interest rates, which I thought was quite an interesting document in and of itself. But we'll move on again because it makes the point very, very clearly. Please. Thank you, Michael. This I found particularly interesting. When Einstein was asked what was the most wonderful thing in the world that he experienced, he said, compound interest. Kind of interesting. When you think about the fact that we are now moving into negative interest rates. Let's go to the next slide, please, Michael. Alan Greenspan, only a matter of time. And for those that were following the news yesterday, we're very close to that point where the Fed may well move to negative interest rates. Of course, they're doing all sorts of other things to avoid doing that, such as purchasing corporate bonds, but that may be where they get pushed to at the end of the day. And we do have negative interest rates in other parts of the world already, in Germany, in Switzerland, Austria, and so forth, which is also kind of interesting. Let's move on then. That just makes the point again in that slide about volatility. Things are very dramatically changing in the world today. Thank you, Michael. Now, I wanted to come back to fundamentals again. In this case, the client lens. What's the client's reaction to the brokers, to the intermediaries? And this strikes at the heart of the question, whether the brokers are symbiotic and essential for the insurers, or are they parasitic, living off the backs, if you like, of the insurers through excess commissions, which is what my friend Bruce Hepburn at McTavish would probably argue, with some justification. But here are the questions typically I wanted to put in front of the audience back in Bermuda that the broker will have to answer to his buyers. I've been in this syndicate for a long time. We've not had any losses for 10 years. And now you're telling me that syndicate's disappeared. The claims man's gone. What happened to my relationship? And should I stay with that particular syndicate or that particular Lloyd's institution going forward? This is a very, very straightforward response that everybody must have got from the clients. I spoke to many of my friends in different broking firms, and they said that's exactly the process we've had to go through with the clients, explaining the dramatic changes and explaining why they were necessary and why we still support Lloyd's. Thank you, Michael. Let's move on. Now, many people have seen this, and there have been very different versions of this, and this is quite interesting, isn't it? Because it shows what the chain is at the moment. And this is the sort of thing that Bruce Hepburn's talking about when he talks about the frictional costs in the industry. And it's what many industry observers talk about when they talk about, are the brokers charging excess commissions? Are the friction costs too high? And the first point I would make is, it's amazing to me that going back to 1997, there were serious attempts made to create an industry utility, such as the banks have with SWIFT in Brussels. There were huge attempts at that by Marsh and Aon and others, but they were blocked and they did not proceed. There is no doubt in my mind that we should have an industry utility that supports transactions, lowers the frictional costs, makes the industry more efficient, removes the possibility of degradation of information, increases the value of the product. And in theory, that would increase the cake for everybody, as it were, at the end of the day, certainly to the benefit of the clients. There are various initiatives going on at the moment with the people at ChainAct, David Edwards and Henri and his friends at Akinova. And if you're not familiar with those and other initiatives, I think it's a good idea, if you're in the industry, that you catch up with those. At some point, and pretty soon, I believe, we will have an industry utility that dramatically reduces the frictional costs. But I want to say one key point here in this debate. I want to remind everybody that it's the buyer that decides whether the broker is adding value and what the broker should receive, whether it's a commission or fee. The buyer decides, not the seller. And we've had this debate backwards and forwards over the years about this duality, dichotomy of the broker. Who does he represent, the seller or the buyer? And I think surely we're all now at the point where we totally agree that the broker is the agent of the buyer, not the seller. Very clear in my view. And it's the buyer that decides what the broker's remuneration should be. Very straightforward in my view. On the other hand, if I was the CEO of an insurance company, I would have no doubt that my first responsibilities are to my shareholders, not my policyholders. As much as I need to serve my policyholders with good products, with great prices, great performance, great service, it is my shareholders who legally I'm first responsible for. So thank you, Michael, for that. Let's move on. Now, I want to stay with this question of the product itself, because over the years, I've been very privileged to sit with very senior officers of major oil and gas companies, utility companies, engineering companies, and so forth, having debates with them about the product that we actually sell. Time after time, I've been asked the question, why do I have to buy so many different policies, different layers? And in fact, it's a poll question that we should really be asking ourselves. How many different coverages or policies does a typical industrial commercial client purchase? What do you think?
Folks, the poll is open, so if you go to your GoToWebinar facility, you can answer the question. I see people answering now. It's a little loaded here, Dennis. Where is 10? Where is 10 on the question? There we go. We're just getting in. Just over half of people have voted right now.
Okay. Well, it'll be interesting when we go to the next slide, won't it, Michael?
It will indeed. Okay, I'm going to close the poll now, if that's all right. And here we go. You should be seeing the responses in a split second. There we go. So the vast majority believe that it's 30%. And I think a number of them have twigged what you're actually about to discuss. So I'll move along, if I may, then.
Sure.
Okay.
Let's go to the next slide. Now, isn't this interesting? And if you start to analyze that, especially if you're a professional and the other taking part in this webinar, you'll probably come up with, as I have, over 200 for a typical industrial commercial client. Remember, they'll have different policies in different countries, in different places, and there will always be the problem, as we're going to go on to next, gaps and overlaps. And I've been asked this question so many times by senior executives in companies. Can you guarantee to me, Dennis, that there are no gaps and no overlaps in all these different policies I buy from different carriers around the world? And the answer is no, I cannot. I'll do my best. I'll work with our experts, and we can work with your lawyers to determine what we think are the gaps and where we think there are overlaps, where we're effectively paying twice for the same coverage. But no, we will never be able to be definitive. And you know, Michael, historically, when the broker goes to the underwriter to ask for clarification, the classic answer you receive is, sir, I will not interpret my own policy. Not terribly useful, I would suggest. So can we move on, please? So here's Dan Glazer, who I happen to have been privileged to meet over the years when he was both in underwriting and broking. He's the CEO of Marsh & McLennan, and he makes this point about the intermediary, about the values that the intermediary brings to the table. And he's absolutely right when we think about, of course, others like Facebook, Google, and Amazon. And it's the buyer that decides that importance, and it's the buyer that decides the value and the price he's prepared to pay. And at the end, he says the importance to the client is a key reason why he thinks the threat of disintermediation has fallen in the face of increased technology. But I would add that that's also the case when you have this sort of dislocation. When your underwriter has ceased doing business entirely or pulled out of the class, who does the client turn to? It has to be the broker. So let's move on if we may. Now, I want to go back to a higher level discussion of this. If you look at it from the point of view of the chief executive officer, the chief executive officer of any company decides the strategy of that along with his board of directors. And he has to make some very big decisions, typically investment decisions, I would suggest, that go out over 3, 5, or even 10 years. Should we go into a new product? Should we go into a new country? Build a new factory? These are all big decisions that have to be made in any company. Now, the CEO and the chief risk manager, not the buyer, the risk manager, sits down with him and they work out what could possibly go wrong, as they say. And we can look at the 4 basic volatilities here: currencies, interest rates, and commodity prices. What's interesting about all of those volatilities is that there are deep and liquid markets in which you can manage and trade off the risk 24/7, 365. They don't close. If we turn to the 4th volatility, which is pure risk, can we say that? Is our product as well defined in terms of a trigger for recovery? Is it comprehensive enough for the modern risks that people are facing? Do we pay the claims promptly enough? I could go on, but the point I'm making is it's the one volatility that stands out as not being able to provide a deep and liquid market compared to the others. There was a time when business schools used to teach that those volatilities were known as the background noise. In other words, they're not key to your business. They're background noise and things that can affect. So that leads on to a question which I asked a number of years ago and I thought was even more relevant today. If you're an intermediary and you go to the carrier, to the buyer, and you say, I can place all your coverages in one program with A-rated security. I will be the only broker. There will be no gaps or overlaps in your program, and I can save you 20% off of your entire insurance spend globally. Would you appoint me as the sole broker? I've asked that question, by the way, years ago of a number of people that I knew well, and each and every one of them said, yes, of course, if you could do that, that would be wonderful. The fact that there's one broker doesn't bother me because I've got one single product. And if you can save 20% off my price, you have the firm order tomorrow. So let's move on. And here's the key question. If I, the intermediary, saved you 20%, but actually placed it at a greater discount, could I keep any difference? Now, that's analogous, as you know, Michael, to a JP Morgan or Goldman Sachs running the book on an IPO, for example. I actually asked this question of 10 people I knew quite well a number of years ago in the risk management world. 9 of the 10 said yes, precisely because you are running the book. And I want to leave that thought for a moment and move on. In order to do that, of course, one has to have a lot of data. And that leads to the question of who has the most data in today's world, the carriers or the brokers? And I would unhesitatingly suggest to you that the brokers, particularly the very larger ones, the Marsh, the Aon, the Gallaghers, have far more data than any of the carriers in more countries, in more classes, in more layers, in more granularity than anybody else. So that technically they have the ability to bring the data together, and technically they have the ability to bring together non-correlated risks, non-correlated geographically, non-correlated generically, i.e. by class. So theoretically, they could bring together American windstorm, Japanese earthquake, and French fire risks in a single placing into the financial or capital markets. Just a viewpoint. Let's move on, please, if we may. I believe that some of the brokers who have been spending a lot of time and a lot of money collecting this data, analyzing this data, scrubbing this data, are very close to being able to do exactly that in the not too distant future. So let's move on one more point, if we may. Okay. Does that mean that the brokers are effectively disintermediating the carriers? No, not in my view. If the brokers are able to come up with such a product, which we might call an EPS product, Michael, earnings per share, which is a subject for another day, it would actually assist the carriers in accessing non-correlated risks in a single transaction. Now, it strikes at the heart of what I call flexi capital, as demonstrated by some such as Richard Brindle in the past when he created Lancashire. For the carriers to have the flexibility to move in and out of classes in the same way their shareholders move in and out of their share rolls, it will be essential for the brokers to be able to perform that function in a nutshell. Thank you, Michael.
Wow, well, that was absolutely fantastic. And I'm delighted to say, not only did you keep to time, you bettered it, which is wonderful because we can really address a number of questions. Folks, we're going to conclude with a poll on parasitic or symbiotic. So before we get there, which is 20 minutes off, do use the facility to type questions to me. And I've already got a few here, if you don't mind. So let's start with those, Dennis. Zoe Layden points out that regulators don't appreciate information aggregation. That's a really intriguing point because we've seen the regulators in the capital markets move heavily into regulation over the last 10 years. A very straightforward example would be their pretty intense attention to indices. LIBOR is preeminent, but it's also led to a number of other indices getting regulatory attention that hitherto wasn't seen as an issue. What do you think about that?
I think that's the heart of the matter, because if you talk to any broker, he only knows a part of any client's business. He may handle the marine, he may handle the D&O, he may manage the offshore platforms, but he doesn't get a total view. Now, the bigger brokers are often used to provide that umbrella view, or it may be that you'll go to a consultant such as a McKinsey to provide that broader view. But who is actually gathering all that data in that degree of granularity? And the answer to me is only, at this time, really the very largest brokers. They have the resources, they have the geographic span, they have the technical skills to bring all this together. Now, I would argue that's a good thing because they could end up providing a much better product, a much more embracing product for the clients than the disparate systems and products that we have today. And it's interesting, Zoe, I suspect that you, like me, would, as soon as you sit down with a broker or carrier, you pretty quickly decide whether they're a mariner, non-mariner, reinsurance person, retro broker, or whatever, right? So that demonstrates just how fragmented the whole thing is.
Yeah, there really are distinct cultures, aren't there?
Very different.
Bob McDowell makes two comments. I think I can turn this into a discussion point, though. The first one, by the way, Zoe's come back to say, yes, Dennis. Bob McDowell's asking here, it's saying, he says brokers, clearly have a reputation as fair weather friends. And he goes on to point out that carriage of goods has reduced substantially in some industries, such as oil and gas, appear to be going into major transformation. And how will these changes feed through to the insurance industry and its stakeholders? And I find that particularly interesting at this time because a lot of clients that we're working with are doing, China +1 or +1 policies everywhere. really trying to put more resilience into their supply chain, which means this is changing rapidly. And I don't think it's the sort of thing you bother to ring your broker up and tell them about. And I can see them coming back and saying, well, when we wrote that policy, it was before the 31st of December. So what are your comments on that? How can the industry rise to that?
Well, a couple of comments that during my career, time after time, the risk managers said, you're the only constant. Insurance companies have come and gone. And we've gone, they've liked my business, they don't want my business. But you, the broker from Marsh or Aon or Lockton or Gallagher's, have been the constant. You've been there for me, even when the carriers don't want to even contemplate writing my cover. So I would argue that from a client's perspective, the brokers are the constant rather than the carriers. And I've been both, so I hope I'm not biased in that view. So the larger issue, what's scary is if the world trade does reduce dramatically, it doesn't matter which side of the economic argument you are, there is no question that products will become more expensive. Because the reason that we have things manufactured in different places is because of specialization. We can get things done more cheaply, more effectively, right, Michael? I mean, it's basically economics 101, specialization. If that reverses in the face of what we're now seeing with trade tariffs, supply chains being changed either for political reasons or for risk reasons, it's the same result, isn't it? A reduction in world trade, which must eventually, I think, lead to higher costs for the consumers. And it's interesting when I talk to some of my American friends and they say to me, Dennis, we're going to bring manufacturing back on shore in the United States. To which I say, well, go on YouTube and take a look at a typical car factory and tell me how many people you see making those cars, for example. And if you don't want to import goods from somebody else, do you think they'll want your Boeing aircraft or your General Electric engines? I mean, the thing works two ways, doesn't it? So I see it as a much bigger issue around this reduction in world trade, reduction in volume of transit, obviously, from a marine transit standpoint, from a supply chain standpoint. And what's scary is much of it's driven by politics, not by genuine concern about the risk of supply chains.
Well, let's move to touch again on politics and regulation. You mentioned, this is from Alan Punter, you mentioned the nirvana of an EPS insurance product. An attempt some years ago by a U.S. carrier was repeatedly thwarted by the SEC as getting too close to share price manipulation. So is there a limit to how much risk a company can transfer?
Well, that's a very good question, Alan. Of course, nobody amongst the regulators would question somebody dealing with the other three volatilities, currencies, commodities, and interest rates. They would say, well, that's just good management. We expect you to do that. So in the question of pure risk, it's the question that Alan's asking is what is that line? And clearly, you'd have to exclude moral risk. And clearly, insurers are not there to pay for a CEO that's done something stupid, gone into a product he shouldn't have gone into, made an acquisition he shouldn't have made. And on that note, one of the ones that's interesting is Bayer, isn't it? Going out and buying what turned out to be one of the biggest possible potential losses in the world with Roundup, right?
Yeah.
So I understand where the regulators are coming from, but I think they need to step back and think about the extent to which they can stabilize the performance of companies, in which all of us are invested at the end of the day, by allowing an EPS type product that's closer to the sort of deep and liquid markets we see in the other volatilities. I think they need to relook at that.
Alan rather perceptively continued and just ask not just how much they could transfer, but how much should a company should transfer, which I think is interesting. Is there to some degree there's an economic limit to that? There's no yes, purpose of existence if you don't have risk. But do you feel that there should be a limit on that?
No, it's interesting, isn't it? Because what a lot of my clients have pointed out to me over the years, if I had one carrier providing all my insurances, in most years they'd made a lot of money. But they may have made money in the D&O, but not on the property. But by splitting it up this way, I end up not getting the benefits of scale or scope, as well as having gaps and overlaps, Michael. You think about that. So really, you've got to look at it in a macro sense, from a totality standpoint. To do that, you need an awful lot of very talented people. Again, I'm afraid, back to the very bigger brokers in some ways. And you have to have the ability to have the data to support what it is you're recommending and that line that you need to go up to. Yeah, certainly, definitely. We can agree that we live in a world that's more volatile than ever. I mean, in the past, we've had asbestos, haven't we? We've had seepage and pollution. We've had all of these things come up, which would hit the carriers hard. over many years, including back years, of course, which is why we're seeing all the legacy deals now. So Alan's question is right. I think we've got a long way to go, however, before we come up against the buffers.
Well, we've got a lot of people here interested in. I think they've kind of bought your thesis, but they're now interested in what are the impediments to it. So I'll start with a few of these. Tony Young wants to know: will a broker still have a role at the small business consumer end, or is this only a mid-large issue?
That's a very, very good question. As someone who goes online to buy his insurance directly from carriers because it's efficient, it's effective, I think that the client, as always, will decide who adds value. Why do I go and buy my insurance online? Because the broker's not adding any value. I don't need the broker to access that. Although it is interesting that a number of carriers that previously would work with the aggregators are now making a lot of fuss, doing a lot of advertising about the fact that if you come to us directly, you'll get a better deal than if you go through an aggregator. So maybe we're seeing that cycle come through. I think it's very difficult for brokers to demonstrate value. The lower the transaction, the more straightforward the transaction.
Good point. Robert Woodthorpe Brown points out, my experience in developing markets was that the client contact officer would discover which services a seeding company required. He would access the various silos within his large broker company, and the silos were unable to communicate to provide holistic cover. He believes this might well have frustrated you at Aon, but do you want to comment on that?
Yes, absolutely. The answer is yes. I had thick black curly hair trying to achieve those things. It is very difficult. Greg's done a great job at Aon of trying to create this one Aon culture. Marsh have always kind of had that. They've always been a company which is very institutionalized. And so they're much more used to working across their divisions than Aon traditionally was. I think Aon's a hell of a lot better at it now. And I think other companies such as Gallagher and Lockton are making great strides in bringing down those barriers. And one of the ways you can do that is to teach your insurance people more about capital markets and finance. Insurance and reinsurance is contingent capital. That's all it is. We make it complex by adding all these mumbo jumbo words, don't we, in the insurance industry? But that's what it is, contingent capital. And if you step back and look at it that way, you can break down those barriers between the brokers and the underwriters when taking the client view.
Well, somebody who has stepped back and looked at it that way is Henri Winon. He points out that 80% plus of the S&P's value is locked in intangible assets, yet most of the insurance industry is largely focused on physical assets. What's your view on this and a path to really offer cover for clients for intangible assets, which have volatility implied and therefore challenge the by the year by year insurance model?
Well, first of all, let me say I'm an unashamed fan of Henri and what he's doing. So I'm biased. What we need, however, is a platform where we can slice and dice different risks, whatever they are, first party, third party, intangible, in a very low frictional cost way. And I'm hoping that Akinova has got that as their vision towards the end of the day. Of course, he's entirely right that much of the value is not in physical, tangible products and services. Absolutely, it's reputation, brand, etc., etc. But it doesn't move away from the fact that anything that provides contingent capital to things that you can't necessarily have foreseen has got to be a good thing in reducing the volatility of companies' performance, particularly given that everybody is stampeded into equities in this low interest rate environment. So God bless Henri and the people at Akinova. Please continue to drive change.
Yeah. Well, he writes another comment, which I think is I'd agree with. But what do you think is the path to getting brokers to appreciate at the operational level that the path to a deeper, more liquid risk market is a path to growth for the industry, for brokers, and serving clients better, and hence not a threat but an opportunity? And I certainly have noticed this over the years. There's almost an instantaneous putting up of the kind of the crucifix every time you start talking about the west side of Bishopsgate. What is there a path to this, or is it just slow accretion?
Well, there has to be, because otherwise the insurance industry is going to be replaced by the capital markets. I mean, it really is that straightforward, in my view. And we've made huge efforts, Aon and Marsh, when we created the World Insurance Network, which then became Accord. And look at Accord, we've got a global standards body whose CEO is a long-time executive, Bill Peroni, from Marsh and Aon, that can help us create that SWIFT, if you like, the banking equivalent, as a utility to the insurance industry that reduces frictional costs and creates a bigger cake for everybody to have a share of. Absolutely. And we've got that model there already. And I keep saying this, I don't know why the industry doesn't turn to Accord and ask Accord to take us to the next step and maybe team up with Akinova, maybe team up with the people at Chain that to create this vehicle that can lower frictional costs, increase the value of the product, increase the cake for everybody. It's very frustrating that this has been going on ever since I came into the business 52 years ago.
I'm going to try and squeeze four more questions in, one being mine. But the first question is actually from a mid-sized broker whom I know well. He sort of doubts motives here. Surely the big broker's creation of covers over the past decade was just an attempt to rob underwriters of their margin.
In the same way that someone suggested the brokers creating the ILS market was bad for clients. Well, I think most insurance companies are very grateful that the brokers created the ILS market, because where would they be without them? And when I read about the squeeze going on today, the problem is, of course, there's a lot of trapped capital, and we can't buy the retro that we used to buy, and it's all creating a bit of a problem at the front end, isn't it? And what that indicates is the carriers at the front end are still inadequately capitalized, in my view. And think on this, Michael. If we can agree that underwriters, whoever they are, where it doesn't matter, Lloyd's, syndicate, insurance company, reinsurance, if they can't get income from investment income or capital gains any longer, they have to put premiums up. If they have to put premiums up, they need more capital and surplus to write the income. And currently they haven't got it because under reserving in the past, the hits to their current bond portfolios, it goes on and on. So I think that if we don't change dramatically in our industry, we will become absorbed into the capital markets.
Now, Dennis, you raised the disintermediation model in the IT sector. Well, it's much broader than IT, but Google, Facebook, Amazon, what have you. I think the thing that we're interested in here is what's the potential for change from insurtechs or fintech? That's a question by Anu Kurmi. But Francis de Zulueta equally asks, when will we see the emergence of, say, Google, et cetera, buying up insurers, which they could do out of petty cash? Sort of a two-part question there. So is this really amenable to technical solution, or is it really a deep industry structure issue?
It's probably the latter. And that's why if I was looking into a crystal ball and wanted to make some absolutely absurd predictions, I would predict that BlackRock or State Street will get together with an Aon or a Marsh, because they've got the risk capital to provide the sort of breadth and depth of products that I think the industrial commercial risks need. There's a prediction for you.
Okay. Another question, really, going back to this point to some degree about what the brokers are up to. Would you like to comment on this huge agglomeration amongst the brokers? We're down to almost just two quite soon. Is that not the case? Is this really in the client's best interest to have that little choice?
Well, again, it's up to the client to decide. There will always be clients that will go to, let's say, Berry, Palmer and Lyle, which is a wonderfully specialist broker, political risk and so on and so forth. There will always be those. Why do some people not use JP Morgan or Goldman, but go to Evercore, for example? Well, because they're boutique, they're very highly specialized in what they do. There's no question about that. So there will always be a balance. Of course, no one company or entity can be all things to all men. That's absurd. Having said that, the world in which we live means that we're going to continue with this aggregation, whether it's insurance brokers, insurance companies, pharmaceutical companies, motor manufacturers, but then there'll be disruptors like Tesla. Tesla was briefly valued yesterday more than Toyota, even though Toyota sells 30 times as many cars. But they're leading on technology, they're putting money into R&D. What the big brokers have is that ability to put that money to work in coming up with new products, new ideas, new services.
Okay. And again, a lot of people here, I think, are buying the thesis, but curious about what's preventing the changes. And we have here John Goldsmith asking, do you think the FCA would still see negotiating more brokerage if you save more premium for a client as a potential conflict of interest? A few years ago, they were strongly frowning on that.
No, because the broker's now running the book. He's not a broker anymore. When you go to JP Morgan or Goldman Sachs for an IPO, they run the book. When you go to a broker and ask him to take a total view of your risk and provide you a total overarching program with no gaps and overlaps, and he's guaranteed the price, that is totally different from the conventional intermediary model that we have today. The broker is in effect warehousing the risk. Now, we know that Goldman, JP Morgan and the others would lay the risk off in advance of the date of the IPO, but they've run the book, they've priced the book. And that's the model that I see in the future.
Excellent. Well, very clear there. And that moves us on to sort of the final area where the audience has kind of rolled over my question, which is great. Really, what I wanted to focus on was under this sort of all risks. I'm using that advisedly. Under this all risks approach, Andrew Ross wants to know who's going to quote insurance cover for multi-sector risk presented by climate change. We've seen obviously the furore over Hiscox and other underwriters on the pandemic. We can see some of the U.S. bits, and I think there's two parts of this. Do you really think that the insurance sector can provide that type of complete and total risk package with confidence, given these types of global shocks?
Well, probably the answer is only in a partnership with government, because it becomes a socio-economic geopolitical issue, doesn't it, at a certain level? That's the reality. If, for example, there's a debate going on in America at the moment, should they give hold harmlesses to employers that ask employees to come back who then contact COVID? And there are those in Congress who say, no, we should give a hold harmless. So all the years of providing a safe place to work, and you can have different views on that, get thrown out the window because the economy demands that everybody comes back and you no longer have to provide a safe place to work. And I mean, that's a huge example, isn't it, of the sort of issue that we're facing here. Should the insurance industry pick that tab up? Should governments pick that tab up? Should we release people from their responsibilities? And look at coal. Quite a number of investors are now saying we're not going to invest in a company that has anything to do with coal or damages the environment. So they become social and political issues much more than this issue of can I just transfer this to someone else. That's why I believe that there will have to be more partnerships between private enterprise, insurance companies, capital providers and the government to more closely define that line and help protect society from the shocks and bumps and the volatility going forward more.
Yeah, so a lawyer once looked at the issue of what did it mean to own something and came up with, I think, 11 different legal definitions. We at Long Finance have been looking at what is government finance, and we've come up with 13 strictly very different roles, three of which are forms of insurance that are largely unrecognized. The government is ultimately the insurer of last resort in many cases, even if it doesn't understand that. One area it did understand that was terrorism. I happen to be, and I'll be curious if you'd agree, a fan of pool reinsurance, which addresses the terrorist market in the United Kingdom. And I would contrast that with TRIA in the US, which is a much more legislative vehicle rather than a commercially minded vehicle. We've then got issues like cyber, where, could be a national one. We've seen the government toy in a way with Flood Re, which is a somewhat complex model. We've got the pandemic obviously looming, and then really the unemployment insurance in that. And we see this kind of coming up at us, and yet we don't seem to be seeing, if it is going to be a government partnership, government really in the room discussing how it's going to manage these risks, which are on its balance sheet, whether it likes it or not.
Well, let me share this with you. After 9/11, the British government created a thing called Troika, which was the three big brokers providing risks for certain aviation risks. And I served as chairman of Troika on behalf of the British government for that period of that, working with the three brokers. And it was very successful. The government made something like £54 million. There were no losses, but it was commercial underwriters looking at the risk and writing the risk in effect on behalf of the government. That's effectively how it worked. And I think that's the sort of partnership that makes sense. Don't have a bunch of civil servants trying to become underwriters. It doesn't make sense. So I entirely agree with you. I like the Paul Reed model. I think it makes sense for the industry to take on the leadership role and be responsible. And God bless Stephen Catlin. There he is again, showing the initiative and driving out from the front to create that sort of solution. Where would we be without a Stephen Catlin is the question. Okay. So I'm with you. I'm totally in favour of that partnership.
Well, all good things must come to an end, and so sadly, Dennis, we've run out of time. But we did, in fact, want to. You would like to question the audience, is that not correct? And if that's
Yes.
okay, I would just set up this last poll, if I might, which is now being launched. So, folks, you've heard what Dennis has to say. It's a very simple one. Is it parasitic or symbiotic? While you're making your responses, I notice Zoe coming back in on touche on the Catlin comment. I think we have a number of fans of Stephen Catlin here, myself included. Just getting the votes in here. Uh, just up to the 50% mark now. Excellent. I'll now closing the poll there. Well, Dennis, a nice split here, basically one third, two thirds. So two thirds agreeing with you, and one third still, as I think many of us do deep down, question to some degree the motivation between some of the firms there. But may I say, absolutely fantastic for you to come on and share so openly the many thoughts that you've had. But I'll come back and thank you, if I might, in a minute. I have two other thanks to give. My first set of thanks is very much to, as ever, our sponsors. Again, your tolerance. I know that many of you are involved either in technology or finance. Those of you in finance will have found this right up your street, but I'm conscious that many of the names here also provide software and systems of use to the insurance sector, as well as some scientific services. So thanks to you. And finally, if I might, thanks to the audience. A very good turnout, something like 85, 88% of the people who booked turned up, didn't find a cup of coffee interfering, and just about everyone has stayed online. So thanks for that. But a look ahead, if I may, a couple of things coming up three things coming up in the 2 days remaining this week. We're going to have a focus on Busan that should interest many of you, particularly those of you in the maritime sector. I've been to Busan a number of times and find it absolutely fascinating how it's rising. We've got an astonishing session tomorrow, Communities Chess with Vinay Gupta, who created Ethereum Frontier and is looking at blockchain, but more from the legal perspective and how to achieve things, but a true technologist with a wide-ranging brief, including, I might point out, disaster recovery. Vinay is also the inventor of something known as the Hexier, which is widely used by relief agencies globally. And finally, we're going to have Maury Schenk on Friday. Maury has presented for us before, but he's going to be looking at another risk. The world's full of risks these days, and he's going to be looking at the threat to encryption from quantum computing and what can be done about it. So a much more positive session than the sky is falling. But it remains for me to come back to you, if I might, Dennis. When we approached you on this, I was thrilled that you agreed to come on board. And I'm absolutely delighted. And we probably couldn't have done it with you dialing in from Amsterdam had it not been for technology. You seem to flit between Amsterdam and Bermuda, kind of hopping over us all the time. But thanks for dialing in today. And unfortunately, I can't let the audience give the applause in the usual way, so I will have to channel them. And I will do so with my little gong here. So thank you very much, Dennis, for today. Hope to have you back, as you hinted there. It'd be nice to have you come back with some of your thoughts as this evolution of an important industry continues. Thanks, everyone, and we'll see you again soon.
Thank you, Michael. Bye-bye now.